the ones that sort of struggle and learn how to sort of survive on their own without that extra capital that you constantly need at an early stage, those are the ones that tend to be outliers. They tend to learn the hard way. They tend to, because there's a lack of resources, they're a lot more efficient with their resources, whether it's money, people, even their shares. They sort of learn. It's baptism by fire, right? They're actually learning out there.
I've been following you pretty closely for over a year now, as you have some ideas that I really resonate with. I've asked you a lot of questions on Twitter, and you've given me some insightful responses in terms of analyzing small cap businesses. Your entire strategy is very unique in that you only target businesses in Canada that are largely undiscovered. Can you go over your investing system in a little more detail for people who maybe aren't familiar with it, and tell me why you only stick with Canadian businesses?
Okay. Well, it maybe a little bit of background might help answer that question. So originally I started as a carpenter. So, physical work that I got tired of pretty quickly. But actually I went into the investment industry, became a broker, eventually became an investment banker. But really what I learned there is that I learned how the system works. I learned how the investment system works. And once I understood that, I sort of figured out little ways to hack the system, find, unique things that gave me an edge. And what I really came to understand is I had to concentrate on something and get real good at one sector of the market. And the sector happened to be microcaps. And then when I sort of, shrunk the universe of microcaps down even more, I thought I had to be an expert in one side of that microcap market. And being Canadian, I picked the Canadian market. And I think what also helped was the fact that the Canadian market, it's less well known, it's less well understood than the U.S. market. So you were seeing valuations that were significantly different than what you were seeing in the U.S. And because I knew how the system really worked, I tried to find spots where I had that extra edge, and really it was a function of studying this one, so I call it my sandbox, studying my own sandbox really, really well, and knowing where those little nuances were, or where the mispricing was, little things like that. So it's really a function of, trying to be an expert in one space, trying to get that extra edge against everybody else. And, because I knew the Canadian system better than any other, that's where I really focused.
Yeah. And so with the companies in Canada that you do focus on, you've mentioned obviously that you want undiscovered businesses. So a lot of these are pretty immediate right after their IPOs. How do you kind of look at some of these businesses that maybe aren't even profitable, or sometimes don't even not necessarily have revenues yet?
Okay, so again, understanding how the system works. While I follow companies that IPO, I tend not to invest in a lot of new issues. What I noticed over time was that a lot of these IPOs tend to go to the market really early. And again, there's a difference between the Canadian sort of capital markets and the U.S. capital markets. In the U.S., the VC market is much more mature than it is in Canada. So you tend to see companies that stay private longer, especially the better ones. They stay private longer, they get funded better. Whereas in Canada, they tend to go public, significantly sooner, because they just don't have the same kind of capital access from the venture capital markets as they do in the U.S. So you see a lot of these companies IPO way too early, and the majority of them actually don't do well. But the ones that sort of struggle and learn how to sort of survive on their own without that extra capital that you constantly need at an early stage, those are the ones that tend to sort of be outliers. They tend to sort of learn the hard way. They tend to, because there's a lack of resources, they're a lot more efficient with their resources, whether it's money, people, even their shares. They sort of learn. It's baptism by fire, right? They're actually learning out there. So what we do is we follow these IPOs and we wait until we see an inflection point. Sometimes I'd say 90% of the time there is no inflection point and the company is done, and it's kind of having to find some other sort of pivot or something like that. But the odd one that does, starts to sort of do the right things, but at the same time, it's not getting the attention from the market, right? You're an undiscovered, almost orphan. You're doing all the right things, knowing the industry like I did. I also know the investment banking side, which drives so much of the microcap space in Canada. The investment banking side does not want to, they don't care if you're making money now, right? If you're making money, there's no reason for them to get involved. So here you have this circumstance where companies finally figured out how to turn into a real business. It's starting to make money. Everybody's forgotten about them. And the investment banking community, who usually does the homework of trying to find places to go and invest capital, they have no need to care because they can't invest any capital in these companies. So you have this small subset of this whole microcap ecosystem that has gone through all that stuff and is grossly mispriced to the market. And that's kind of where we come in. We try to capture that company at that inflection point before anybody else pays attention. And hence, this undiscovered sort of feature that we keep talking about.
Gotcha. And I definitely want to get more into that. But first, I just want to get to know a little bit more about your background. So you mentioned you have a background in construction and investment banking. And I've also just from my research saw that you've also worked as a stockbroker and some startups, I believe, as well. So my question is, how have these experiences that from previous jobs that are, obviously some of them are investment related, but how have they helped shaped your investing strategy and philosophy today?
Well, construction helped shape it because I realized how much I hate physical work and how lazy I actually am. No, I mean, work ethic, that's part of it, I think, from that type of job. But what where I really started to understand business is in the startup phase. I was involved in two companies. I was a founder of two tech startup companies, and really learned again what the market looks like from the inside of a business rather than from the outside. So I really understood how investment bankers work and how the industry treats companies that are successful, then not successful, need money, don't need money, all those things that allowed me to sort of be behind the curtain and understand what goes on behind these businesses while they're trying to deal with capital markets. So I think that was a real, good experience for me. I also realized, we had a very successful company that went public, and we had one that that wasn't able to go public because it couldn't get enough money. So you really start to understand the capital requirements and needs and how the industry and just the world sort of revolves around you as you're trying to grow this little business. So that was real helpful. And then, of course, I said, once I was in the capital markets, the sort of the knowledge I gained from there was really, how all these companies sort of struggle and have to deal from sort of that end of the business. So, I come to investing, I think, with a lot of, unique experiences that allow me to have different views on these businesses that I eventually try to invest in.
So on one of your previous interviews, you actually mentioned two books, but one that really stood out to me was What Works on Wall Street. You said that this book had a pretty big impact on you. And I was just wondering, what are the primary areas of that book that helped impact you and shape your current investing system?
So, there's a number of books that really have had an impact. What I like about most of these books are the ones that have given me an impact. There's at least one or two takeaways that I get that sort of have shaped my investing strategy. What Works on Wall Street, what it did was basically, it almost, I wish it was the first book I read when I got into the industry, because it took me, 10 plus years of experience and trial and error and school of hard knocks, whatever you want to call it, to learn what I learned in that book. And it solidified my belief that where I was operating was the place to be. So What Works on Wall Street is basically a synopsis of all the data from, I think, over 100 years of how the stock market works and what works, best in there. So whether it's large caps, mid caps, small caps, all those things, growth versus value, And over time, what they found was that basically small, profitable growth companies far, sort of outpace all the other categories of stocks, right? Now, I learned that by mistake but trial and error over 10 years, right? Had I known that in the beginning, I would have spent a lot more time focusing on that. So that was a big thing. It really gave me the confidence that where I was working, was the place to be. And it really just allowed me to double down on stuff that I was experiencing and seeing that was working.
Yeah. Yeah. I got the book and I really enjoyed, a lot of parts for it. I bought it after you suggested it. So I already saw that, I kind of had that lens of the small cap. So I looked at everything that they mentioned about small cap. And yeah, I mean, like you said, the data really does support small cap performance. And then it has some other really interesting things. Like I know you also mentioned, price momentum, and buying at 52-week highs and how that can basically help impact the way you invest as well.
Yeah. So that I got from a different book called How to Make Money in Stocks. So by William O'Neill. And that, like that one I actually read before What Works on Wall Street, and it kind of blew me away because I'd studied the markets, I'd read all sorts of books in the past. I'd actually gone through my course to become a broker and get licensed, and throughout all these other books, it was basically ingrained in you that the idea is to buy low, sell high, right? That buy when something's low and sell when something's high, and that's sort of the nature of everybody's thinking when it comes to investing. But this book really changed my line of thinking to say, okay, no, you want to buy high with the idea that you're going to sell a lot higher. And by buying high, what you're finding is companies that are actually already doing things right. If a company is going to go up 100 times in value, well, it's going to be hitting a 52-week high a lot of times before it gets there. So that was one of the key things I got from that. But then also the criteria that you have to look for that justifies why it should keep going higher and higher. And it's things like rapid growth rate, it's sort of a smaller amount of shares outstanding. I really start to understand the discovery process, because you want to buy before all the institutional investors are buying. These are critical pieces. There's a number of other things in there, but it really was. I like to say it changed my financial future, that book, when I read it, because it really put so many of the theories that I had ingrained in me. It sort of threw it upside down, and really made me think differently, and sort of allowed me to finalize the strategy that I have now. It's a big cornerstone of what I do.
So I've had the SEDAR experience, and seeing the website makes me think that I'm logging onto the website with a dial-up for the first time. So for those of my audience who don't know what SEDAR is, it's an acronym for System for Electronic Document Analysis and Retrieval. So for US listeners, you can kind of think of it as a Canadian version of Edgar. So you've said that the SEDAR process and the fact that it's, ancient looking is part of the advantage of your system, because only those who are willing to do the work of going through all the different filings are going to find the best opportunities. Is there any new technology that you've come across that helps you filter through SEDAR more quickly, or is it still all manual work? And if there was technology to come along, do you think if technology were to come along that would make filtering SEDAR easier, do you think your system would still work as well as it does now?
So yeah, I think I have a competitive edge because, like you said, this system from the 1980s, which, by the way, they've just changed it over the last couple of weeks, and I didn't think they could make it any worse, but they actually did. So I'm happy about that, because that's going to block a lot of other people from doing what we do. No, I think there's always tools that can make it a little bit easier, and there's all sorts of software screening systems that are out there. But I've got experience that some of these software systems, but there's always one or two that fall between the cracks, and the beauty is those are the ones you actually want to find more than any others, because it's significantly less discovered. If everybody's using software to try to screen these, everybody's doing the same thing, there's no real advantage, right? So we do it manually. We physically read filings. We also get a feel for these companies when we do that. So doing software screening by itself is not going to give you the same feel as reading an annual report or reading quarterly report. So I think we'll always have an advantage in doing that. you get that different feel. You get to understand companies a little bit more. And what we end up doing is we start to, we almost get a feel for a company before it triggers the criteria we look for. So we'll get to know companies a little bit better by doing this manually. And just so you know, like we spend maybe a half an hour to an hour a day, depending on how busy the filings are that day. And we go through them all on a daily basis. And then several times a year, we'll do sort of an A to Z where we go through all the companies again. And it's a big advantage. Like, it's a big advantage. We've seen in the past, one of my biggest wins ever is a company called Expel. Expel, for a few different reasons, fell between the cracks. It was very undiscovered at the time we found it. I found it using that manual process of going through filings. And, as long as I've had that as an experience, I'm going to keep doing it. Like, you can't, no point in fixing it if it's not broken. So I'll keep doing it.
Excellent. So you mentioned in other interviews that you're looking for 2 consecutive quarters of earnings before a business starts to interest you as part of your discovery process. So how do you view short-term tailwinds as part of your process? Are there specific areas in a business that are displaying some durable competitive advantages that make you confident that earnings are likely to stay positive for the near future? And what might signal you that the earnings boost is only short-term?
So, that's a great question. It's something that's really been prevalent over the last couple of years because of the pandemic. We've had a lot of businesses that have sort of had paradigm shifts that, are short-term in nature, and then others where, there's probably a longer-term tail to it, but may have been, impacted by pandemic. So a lot of work that we do is to really try to determine how and why the trend is in place. So the reason we look for 2 quarters of, profitability, that doesn't necessarily mean that's the first time we've seen the company. We may be tracking it for several quarters, and now those 2 quarters have triggered what we're looking for. We want to see a trend, right? One data point or 1 quarter is not a trend. But if we have several quarters, now we can identify that there's a trend here. And then we want to try to identify why that trend exists. If it's because there's a brand new product, then likely that product is not just a one-off and it's fleeting. We want to see if that product has longevity, and we want to understand a bit of the competitive market. So there's a number of things we look for, and quite frankly, a number of the other criteria we use sort of increases our odds that we're onto something where that trend has longevity. So it's a bit of a trigger point, but that's likely a trigger point after a number of other trigger points that we've been dealing with. And like I said, in most cases, we've been following the company for several years, and now that's just that point where we're so, okay, now it's time to look at buying it.
Makes sense. So moving on to the retail part of investing. So the retail interest in nano caps and micro caps seems to be getting larger and larger. With the popularization of websites like yours, the Small Cap Discoveries, Micro Cap Club, Twitter, Substack, there's a wave of new retail investors that are discussing or seemingly discussing less discovered ideas. Are you finding that this wave of new interest is disrupting your strategy in any way, or is it just kind of validating that an idea that you have is already undiscovered if no one's still talking about it?
Another good question, and I've been doing this so long, I've seen waves of this sort of stuff come and go. Back years ago when I first joined the Microcap Club, I remember there was what seemed like a large group of investors that were interested in microcaps. But what I really learned was we were fanatics. Like, we were a smaller group than I thought, but we're just crazy enough to want to deal with microcaps. But what you tend to see is over time, when microcaps are really working well, you see a big influx of investors coming down to the microcaps. And when things get, bad or slow, they sort of leave, right? And I'm less worried about the retail investor than the institutional investor. What the other thing I recognize is that, again, in my days in the industry, I saw this, the institutional investor tends to go up and down market as well. And that's really where the capital is, right? So when, retail can have a little bit of sort of an influx of capital, but when the institutional guys come, that's when you start to see meaningful moves in these stocks. So I almost say that the retail investor tends to be a lot more emotional. So they tend to be very fleeting, and they don't have that same impact. And what I also find is that if you get really good as a retail investor, you get really good at the microcaps, sooner or later, you've outgrown the microcaps, right? So you're constantly, I hate to call them amateurs, but if you stay in the microcap space, you're constantly sort of competing against amateurs. So I'm not worried about the retail guys. It's the institutional guy that finally wakes up one morning and says, hey, wait a minute, there's just too much value down in the microcap space. I better get down there. And right now we're not seeing that. We're seeing quite the opposite, where institutional guys are going up market because they want liquidity. They want assurance that they can sell something if they need to. But like I said, it comes in waves. I'm not worried about any of the other retail guys right now, other than, there's a handful of real smart guys that I have to bump my head against all the time, but so far so good.
Yeah, interesting. So with the waves of interest, obviously that happens all over the market, but have you found that there's been waves of interest from institutions specifically into microcaps in the past, once the valuations get more attractive, or if you start seeing bubbles in there that just start attracting more capital?
Well, yeah, like 2 years ago when we had a real bull run in the microcaps, that's exactly what happened. You saw institutional investors. What I've really noticed in my career is that you tend to see these levels, these microcap or market cap levels that are almost gates, right? So really almost anything under $50 million market cap in Canada, you see very, very little, if any, institutional interest. Between 50 and 100 million, that's when you start to see some of the smaller groups start to come down market and play in that area. And then over 100 million, that seems to be the real spot where these institutional guys start to take an interest. So when things get real exciting, you see them start to move those levels down a little bit. So I've seen, in the height of the bull market for microcaps, I was watching them invest in 10 and $15 million market cap companies, which was, right now, they wouldn't come close to anything like that. So yeah, they come down, and of course, the minute they get spooked, they run away, and hopefully that's when guys like me come in and start to pick up the pieces after they've run away with their tail between their legs. Yeah.
Yeah. So with this discovery process, you've been obviously doing it for a really long time. What are the primary risks that you've observed or maybe you've experienced from using your process that you've created?
Okay, so I mentioned liquidity a couple of times. I think that's something you have to. Your batting average has to be a little bit better than average if you're playing down here. Otherwise, you're going to get stuck with investments that they're going to be very hard to sell, even if you wanted to. Especially as you grow your portfolio in size. If it's small amount, then it's a little bit easier. But that's one of the issues. So you have to have a high degree of confidence in the investment you're making. You have to have that margin of safety, really. So that's kind of what I'm looking for, is to mitigate some of those. And the way I structure my portfolio actually is how I deal with some of that risk. So my initial position, my starter position, anything I really like, it's never too big that if something goes wrong and I can't get out, that it's going to have too much of a material impact on my overall portfolio. That being said, from time to time, I'll grow my position because things are going well, and then something goes wrong. Well, ideally, the stock's gone up enough where even if I'm selling, I'm doing okay. That's kind of what I've seen historically happen. So, I'm as I'm getting older, maybe it's my conservative nature as I get older, or just laziness or what. I'm saying no more often, and I'm trying to really find those fat pitches or those opportunities where, my risk is far outweighed by my upside, and it gives me that ability to take a chance. And like I said, part of my sizing is my strategy to mitigate some of that risk as well.
So you mentioned previously that in this interview that you every 6 to 12 months that you like to go through all companies in your investable universe, starting with the A's and down to the Z's. You mentioned that this process usually can bring up anywhere between 5 to 10 names that interest you, but I'm interested in knowing how long this process takes, and outside of obviously finding interesting names, what other hidden benefits does this process give you?
So It usually takes us. I've got a partner that I work with that helps me go through these, so we sort of compare notes at some point. But it'll take me a solid week. I basically have to lock myself in a room and have my wife feed me under the door for about a week as I go through these things. But so yeah, we do it 2 times a year. We've already got a comfort level with these companies because we've seen them already, so it doesn't take us an inordinate amount of time to review them. But the benefit is that we feel confident that nothing's slipping between our fingers, right? So we're making sure that we've got the whole landscape covered. But the other thing it does, it helps us when we find things or we don't find things, it helps us gain confidence in our existing portfolio, right? We want to feel like we have the best stocks that are hitting our criteria out there. And if we review at all times, then we sort of know, where the good stuff is, and hopefully it's in our portfolio, right? So it gives us that added comfort that, that we own the best of the best in the space that we're looking at.
Yeah, that makes sense. And so you mentioned that you have a partner. So does having the partner definitely make that process of going through them a lot quicker? Like, are you guys, splitting it up 50-50, or are you literally all just going through it, both of you going through all of them and then just kind of comparing notes between everything that you
Yeah,
have?
so we go through all of them and then we compare notes, right? So it's not that it makes it quicker. What it does, if anything, it makes it longer because we'll argue things, right? Which I think is very healthy. And we come at it from different angles too, right? So my partner used to work for the TSX exchange. He was an analyst there, so he has a slightly different view on things. He's a lot more looking into some of the reasons and some of the filing components of what they've done, whereas I'm looking at it much more from a fundamental standpoint. And then I mean, the other big piece we do is we actually look at some of the people and because of our context within the industry, we sort of get a bit more due diligence on some of the people, not just in management, but in the microcap space. You have to understand there's a lot of people in the background, right? There's a lot of financing people and people that are, major shareholders and, things like that you need to know. So coming at it from two different angles, coming at it from different viewpoints, being able to argue different ideas, I find that very, very helpful.
Excellent. So how do you view shares outstanding growth during the discovery process? Since many of the businesses you are looking at are just recently turning profitable, is it safe to assume that many are going to be issuing equity in order to finance their growth? And how do you factor dilution into whether the investment will create value for shareholders as they continue to grow?
So that is one of our key criteria we look for is the amount of shares outstanding, and we try to determine what the financing risk is, right? What's the risk that they're going to need to finance and dilute some more. So one of the nice things is when a company does turn profitable, right? That's sort of the gatepost, if you want to call it that, where they're finally in a position that they don't need the market to continue to fund them, or at least they're significantly closer to that point. So it's not unusual though to see companies at that point still want to get some outside funding because there may be, they may be growing now for a reason that requires them to bring in more money. They've launched a new product, they want to grow faster. Maybe they've seen some acquisition opportunities, but usually when they get to that inflection point, the reason they're looking for cash is to further grow their business, right? Either through an acquisition or product launch, something like that. So it's actually a good reason to raise money, in my opinion. If a company's burning money, if they continue to lose money, we find that is not as good a reason to go and raise money. So we try to avoid that. But I'd almost say at that point, it's less than 50-50. There's still a lot of companies that will go out and raise money, but the majority won't. And sometimes we look at the companies that are raising money. Sometimes that actually turns out to be an opportunity, right? Because these are illiquid companies in a lot of cases, especially if insiders own large positions. Sometimes we'll actually approach those companies and say, look, your balance sheet is still a little offside. You need some money. Why don't we raise the money? Why don't we give you the money? That's how we get our position. You guys get the capital you need. You've got a good sort of capital markets partner, and you guys can, accelerate your business. So we don't necessarily view it as negative. We view it as potentially as an opportunity, but it is something we want to really understand. And, kind of once we're involved, we want to kind of say that there's not a lot of reasons to go and raise more money, right? Unless it's something that's going to really, really change the growth pattern in the business.
Hey, so I'm going to talk to you about Foundation Devices, which is self-custody done right. They built a premium grade hardware wallet called Passport right here in the United States, and it's fully open source verifiable. It's the most intuitive Bitcoin hardware wallet designed with a UX reminiscent of a simple feature phone, so you'll know how to navigate and use it the moment that you pick it up. Get your Bitcoin off the exchanges and into your own hands in just a few minutes. Experience the peace of mind that comes with taking ownership of your own keys. After a massive May sellout during the Bitcoin Miami 2023, the Passport is back in stock at foundationdevices.com. It's Bitcoin only, it's open source verifiable, it's got a completely offline air gap security model, it's got a gorgeous design craft, and it's all premium build materials. If you've been thinking about getting your Bitcoin off exchanges, which I highly recommend, then this one's for you. So go check out this awesome hardware wallet at foundationdevices.com/fundamentals, or check out the Passport link in the show notes below to learn more.
So you mentioned, and I mentioned previously about how you enjoy using kind of momentum and looking at stocks that are trading at those 52-week highs because it is starting to show an inflection point in the business. So with that, obviously, stocks trading at 52-week highs can obviously be offering returns that aren't necessarily the best. So how do you interplay looking at stocks at the 52-week highs as well as value? And are you finding that in the microcap space that there are sometimes stocks at those 52-week highs that just, they're not feasible investments because of the price?
Okay, so the function or understanding what drives a 52-week high is something that sort of has made my strategy what it is. But I don't just buy companies that are hitting 52-week highs. Sometimes I'm the driver, or sort of the discovery process, whether it's me or somebody else. That's what starts to drive this sort of move or trend towards 52-week highs. So more times than not, because I've got a larger pool of capital than I started with years and years ago, I'm more confident in buying before it's hitting a 52-week high if the fundamentals make sense to me. And then what ends up happening, because some of these companies are relatively liquid, I'm the driver of that 52-week high, or somebody like me is the driver. But now, because I understand what's driving it, the company's been discovered. The company is now being noticed. And if I have a position and I'm starting to see that happen, then I understand where it is in that discovery process, right? So it's not make or break anymore. I don't need to see a 52-week high, but I love to see it once I feel the discovery process has started, and then I can fine tune how I sort of act based on that 52-week high, right? So I'm not afraid to add to my position because it's hitting a 52-week high. That's actually encouraging me to add to my position. So it's things like that, having understood what it all means, the background fundamentals that drive it, the background discovery process that's driving it. And then ultimately, it helps in determining how I go about selling position if necessary.
So you've said in previous interviews that after buying a stock, you are often trying to find reasons that you would not want to add to the position. So obviously it's going to be company dependent, but what are some of the types of fundamentals of specific businesses you're following that help you determine when a business is indeed improving and maybe you should be putting more of your money into?
So it really, you establish a thesis as to why you want to own at the beginning. So, let's say a company's growing at 30% a year. It's trading at single digit, price earnings ratios. Its earnings are growing nicely. There's leverage in the business. These are some of the fundamental reasons why we actually want to own that stock. So provided those things continue to happen, sometimes we see an acceleration of growth. We see acceleration of that sort of stuff. We're going to continue to own that stock. We're going to continue to want to own more of it if it keeps sort of giving us a margin of safety to what we think the real value is. So those are the drivers that we're going to constantly look for. Now, if something breaks down and all of a sudden, the company's not growing anymore, well, that starts to give us a reason to look at selling, right? That's one of many different reasons, but that's one that we're going to look at. And then remember, we're not just looking at our portfolio, right? We're measuring our portfolio against everything else that we have an opportunity to invest in. So if we see a company that's growing at 30% a year and it's trading at 15 times earnings, but we just found another one that's growing at 100% a year and trading at, 10 times earnings, well, we've got to offset that decision, and maybe that's a reason we're selling, even though this other one is doing okay.
So, what are some red flags that have been thrown up in an investment that you've already purchased, that have prevented you from adding to a position or maybe trigger you to exit earlier than expected? So you mentioned a little bit just previously, but how are you looking at, say, returns on capital, margins, KPIs? Are all those types of things also going to be helping guide your decision-making if you need to get out or add or just maintain a position?
Yeah. So exactly, that's exactly what we're looking for, is some deterioration in the underlying business, whether it's, something that's, again, like I said, the growth has changed or maybe the profitability has changed. We want to understand why these things are happening. Sometimes you'll see them because they're going to, they're investing in future growth. Their R&D spend is going up because they've got some new products they want to launch. Maybe they're spending more on marketing because they want to get more aggressive in growing the business. These are all things that you have to sort of understand to determine what the future outlook looks like and what the risk profile of whether it's changed or not. So those are things we look for. But more significantly, the fundamentals can be relatively easy to understand and see if there's deterioration there. But there's a lot of capital markets things that microcaps do that I think are red flags, right? When you see them start to issue a lot of shares, when they're looking at financing for reasons that don't make a lot of sense, or they're spending egregious amounts of money on investor relations or something that doesn't make a lot of sense, then you have to question their capital markets sort of savvy. And I've seen a lot of companies sort of fall apart when they don't understand that part, right? Maybe the insiders don't own enough stock, so they're trying to, they don't have the same vested interests as shareholders do. You've got to watch the capital market steps that they make very carefully. And I learned years and years ago that you want to, and this is part of our due diligence, is you want to really understand the makeup of the board and to see if there's someone in there that can help guide the CEO in making sure he doesn't make sort of standard capital markets mistakes. And there's lots of them. We see a lot of that goes on. And sometimes it's not the fault of the CEO. They just don't know better and they're getting some poor advice.
So looking at that board member that you just discussed who could maybe help guide, how do you know what person to look for in the board? Is this just part of your due diligence process when you're looking at a specific business, or is this kind of insider knowledge that you know from having worked in the industry for so long?
So it's a little bit of both. A lot of times when we do look at a company, and sometimes through an interview with management, we try to determine who on the board has a vested interest, meaning they own a significant amount of shares and have capital markets knowledge, right? So somebody, usually you see a board that has certain different industry expertise, and sometimes it's all based on the industry that they're in. And that's fine. But when you get a legal question, when you get an accounting question, when you get a capital markets question, who are their advisors, right? And if their advisor is an investment banker, then, we get nervous, right? Because there's two different sort of perspectives or incentives there. So we want to know that somebody that's sort of been in the capital markets, ideally, is sitting on the board and can sit there and say to the CEO, no, you don't want to do that. You don't want to do that kind of financing. You don't want to, spend that kind of money on IR. You don't want to do those things, right? They're doing it because they've got a vested interest in making sure the company's fine, right? So we constantly ask and try to determine who on that board has, a meaningful stake in the business and has that experience to be able to tell that CEO, this is what you should do and this is what you shouldn't do. Yeah, and quite frankly, it goes for everything else on the board, right? You want to find a board that has good rounded expertise that the CEO is going to draw, mentorship from or advice from. And without that, you question what that board is really doing.
So I know that you've been a pretty concentrated investor in the past. You've discussed that you've had one stock make up to something like 60 to 70% of your portfolio at one time.
Mhm.
May I ask what that name was and what are normal levels of concentration for you like today?
Mhm. I've had a number of them, so it's not just one, but Expel was an example. Now, but part of the problem is, and you sort of you sort of wish this because it didn't start off as a 60, 70% piece of my portfolio, right? It grew into that. And when you have a company that's going up 10, 20, 30 times in value like Expel did, pretty quickly it can be oversized position. I'm not a believer that you trim because it's become a big, sort of a big percentage of your portfolio. It happens, you want to constantly make sure that you got that Wayne Gretzky in your lineup, right? And if you got him, you put him on the ice as much as you can, you hold him as long as you can. And then when you see he's kind of, he's losing his edge, then maybe you take him off the ice a little bit. So that's my approach. It's always been my approach. I never, ever, a starting position is never going to be an outsized position. It's going to be a couple percentage points and they have to earn their way in, right? So I could grow a position of maybe 10, 15%, but at that point, if it's going to get any bigger, it's going to get bigger because it's just moved in size, right? So that's sort of the makeup of my portfolio. I'm not afraid to concentrate. I tend to know these businesses better than almost anybody else. That's part of what we do. And like I said, that confidence also comes from the fact that we're constantly looking at everything else that's available and we're comparing it to everything else. So if it's gotten that size, it's usually because it's just better than everything else we see that's available, and we're just not going to sell it.
What are normal holding periods like for your stocks? Do you average up when the opportunity set looks like it will be longer than when you first imagined? So for instance, let's say you put in a full position by cost basis of, like you said, maybe 10 to 15%. If the business is just continuing, like maybe you observe that it has 5 more years of growth that you didn't account for before, will you continue averaging up, or do you kind of set hard limits on that end of the portfolio management spectrum?
I love averaging up. I love it. I love it. I love it. I've learned the hard way to love it. So much of this is all through experience and what I've dealt with. So my biggest mistakes in the market have not been, hey, I bought this stock and it went down. That's normal. It happens to everybody. And my biggest mistakes have always been, hey, I've got this one stock and it's going up, and why don't I start selling it because it's going higher and I'm making money. Where I really learned this the hard way is I had a company years and years ago called Bowflex. And Bowflex, if you're old enough, you remember those exercise machines and you name it on TV. But it was a company that was growing very rapidly. It was an undiscovered company. I bought it around $1 a share, and within about a year and a half, it had already 10x. It was like $11, $12, and here I am thinking I'm a genius. I'm selling this because I'm up, even though the company was still putting out the numbers. It was still very cheap based on its growth profile, and I'm selling it, right? And this thing eventually, I think after splits and everything, it went about to $250, $300. I mean, it's still around. It's called Nautilus on the New York Stock Exchange. It was just a monster. So my mistake wasn't sitting there and owning the stock. My mistake is actually how I held it and how I sold it, right? I should have been averaging up all the way. Instead of selling it all the way up, I should have been averaging up, right? So, having learned that from so many situations, if you find a company that is fundamentally still proving out your thesis, that you can argue is still undiscovered and giving you a margin of safety to what you think the valuation is, it's telling you should keep buying it, right? Keep buying it until your thesis breaks or until you have something else that's just egregiously more obvious than this one. So for me, I love averaging out because it's a sign that business is doing the right thing. It's a sign that the discovery process has at least started. And I'm comfortable owning these things for a very long period of time if they continue to perform.
What are your normal holding periods like for your stocks? Do you, obviously it kind of depends, I guess, right?
Mm-hmm.
There's certain businesses where, maybe you're only looking for a 2 to 3 year opportunity or maybe even shorter. But on average, how long would you say you like to both look for holding a stock, and how long do you actually end up holding stocks for?
Well, first off, I'll say my losers I hold too long, and my winners I hold too short, no matter what. Even if I hold the loser for a day, it's too long. So what I find is, look, I've got some stocks that I've held for 5 or 6 years, and I'm comfortable. I don't set any kind of timeline target. It's strictly a valuation target, and if anything, the largest or the most or the reason I sell more times than anything else is because I found something that's just a better opportunity, right? So that's usually the driver of something. So I've got no problem holding stocks for 5 to 10 years, provided that I don't find something that's a better opportunity. So it's rare that, after 5 or 6 years, I can't find something that's a better opportunity, because if things are working, then that whole discovery process, which, we haven't talked too much about, but, you'll understand what drives it. And our belief is that once a company's fully discovered, you're only going to get the sort of the performance of the business rather than that discovery arbitrage that you can get.
So why don't we dive into that discovery process in a little more detail? What specifically are you looking for in the discovery process that is helping you get these, outsized returns in stocks that are, trading not only at very low evaluations, but are also growing very, very fast?
Mm-hmm. So, our belief, and I think it's played out by, a lot of the books we've read and even the experience that we've had, but stocks change in value based on how many people really come to understand that business, right? So, some companies will toil in obscurity because there's nothing that's going to trigger that discovery. They're either not making enough money or they're not exciting enough to get somebody interested in the stock. But from time to time, companies that are going to do very well, something will trigger a sort of initial level of discovery. So it could be an earnings statement. It could be a newsletter writer. It could be somebody, a company jumps on a podcast like yours and has a bigger audience. All of a sudden, more people find out about the business, and hence that larger audience is able to drive that share price, right? When you understand that, you're understanding what really is the process that drives margin expansion or price earnings expansion or whatever valuation expansion you want to talk about, right? Why does a company like Expel, like when I found Expel, it was trading at about 8 times earnings, right? And it was growing over 100% a year. And yet now it's at $80 plus. And I think it trades around 40 times earnings. And it's growing actually slower, right? So what drove that? Well, everybody knows Expel now, whereas back when I looked at it, nobody really knew it, right? So understanding that process, I think, gives you a massive edge, and gives you that opportunity for that outsized gain. You got to know what triggers these things. You got to know how to determine if it's triggered yet or not. And you got to determine, like, if everybody's talking about a stock, it's discovered, and more times than not, and you've seen it, right? More times than not, the stock's probably overpriced, right? But if nobody's ever heard, if you go to, 20 of your investing friends and say, hey, have you ever heard of ABC? And none of them say yes, that's kind of what gets me excited, right? One of the things we do is, like, when we actually finally decide to talk to management, we usually do a lot more, a lot of work before we even talk to management. But if I phone a small microcap and I ask for, it's happened before, I'll phone the receptionist and say, I need to speak to whoever handles your investor relations, right? And if she has no idea what I just asked her, if she's confused and doesn't know who I'm supposed to talk to, I get excited, because that means there's not a lot of people that have phoned that company, right? It's things like that drive our excitement. If all of a sudden, she immediately hands me off to an investor relations expert or some outside party or something like that, then I know that, they tried to get people to hear about it, or they tried to get discovery and exposure, and I'm less interested in, right? I want to find a company that's not discovered. I want to understand that. And quite frankly, if necessary, I'm going to help that discovery process. I'm going to phone institutional investors. I'm going to phone other investors and say, hey, you got to look at this company, right? And that's how it starts.
That's really good. So you mentioned earlier in this interview that with the fact that a lot of the stocks you invest in are illiquid, you have to be right a little bit more often than maybe, say, investing in larger companies that are more liquid. What would you say your hit rate is like with your strategy? Do you find that your winners are kind of following a power law, and then, you can find something like XPEL that carries the entire portfolio, while you have maybe a few other stocks that aren't necessarily losers, but maybe some that just aren't budging? Maybe the discovery process just is taking a little bit longer than you thought, or maybe some of them, maybe you just make a mistake on it and lose some money on. Yeah, I'm interested in knowing that.
Yeah. So I mean, I don't say the style or the strategy we use is very conservative inside the microcap space, right? There's thousands and thousands of microcaps. I think we did a check, and only about 5% are actually profitable, right? So immediately we sort of X out that 95%. So we actually think, because we're doing that, our odds of success are significantly higher. And then because we're looking for that undiscovered component as well, we think that we've shrunk that pool of viable businesses even better. And quite frankly, our hit rate is actually quite high. I'd argue it's probably in the 60-70% range, which is, I think if you're hitting 50% in this business, you're actually doing quite well. But we've hit higher than that. But that power law that you talk about still has that impact, right? So our losers might be up 10 or 20%, but we're not in the business to try to get 10 or 20% wins on these stocks. We're looking for that outsized gain. So we do, our hope is within that pool of companies that we have that 5X or 20X that we might see in 3 or 4 years. And we get those, right? And the thing is, though, as we see those really start to take off, we want to have less of those 10 and 20% gainers and try to focus more on those Wayne Gretzky's again, like I said. So you do get that. You get an opportunity to see the big winners early. You get an opportunity to double down on them sooner than others. And that's really where you get your gain. You're going to get it because you're going to manage that winner properly, as opposed to a diversified portfolio and hope and pray that, 2 are going to be big wins. You want to really double down on the ones that you're seeing have that escape velocity.
So looking at the other side of the discovery process is obviously the exit strategy that you have. So you've discussed quite a few little things that you look for when exiting, but what other things, other than, say, things like once they get more discovered? So are you looking for things like added institutional ownership, increased analyst coverage? What exactly are you looking for that it's going to that's going to trigger you to exit an investment?
Yeah, so great question. Selling is the hardest thing to do in this business, right? It's easy to sort of pick and choose a few stocks and hope to go up, but when it comes time to selling, especially like selling a loser is pretty quick for us, right? We once the thesis breaks down, it has nothing to do with discovery or not. If the thesis breaks down, it's time to head for the exit door. But the things that we look for that start to tell us when a company's fully discovered is, like you mentioned, if an analyst starts to cover a company, it goes into a different level of discovery, right? There's what we call retail discovery, and then what we call institutional discovery, right? So when we start to see a number of analysts covering a stock, that doesn't mean we run for the hills, but it means, look, we're now into that secondary level of discovery. When institutional investors start to participate, that's another level of discovery. When you get that $100 million market cap and you're getting those two things, the analysts and the institutions starting to trigger, that's another level of discovery. But then the other one that I've almost joked about is like when you start to see analysts on TV talking about this company, when you start to see institutional investors talking about this company on TV, that discovery process is when we completely run. Now, we've got a different dynamic in Canada because right now we're just talking about the Canadian sort of market, but sometimes these companies continue to grow and they go into the US, and then you got that whole different level of almost international discovery, right? Because now you start it all over again. You've got a bigger pool of retail investors. You got a bigger institutional pool that might start to look at a company. So again, like XPEL, XPEL graduated from a Canadian listing to eventually a NASDAQ listing. And all that time that while it was a Canadian listed company, it never had any analyst coverage. So from like pennies to $8 roughly when it went to NASDAQ, there was no analyst coverage. there was barely any institutional ownership, right? It was bizarre, right? The minute it got to the US, it just started to get discovered there. And of course, it went 10x from that point there. So you have to understand the different phases. You have to understand where it could get caught up and say, okay, that's about, it's never going to go to NASDAQ. It's never going to get that US audience. So this is kind of as good as it gets. But I got to be clear that, if what you've done is once that discovery process has run its course, now you're just sort of left with the performance of the business. And while the performance of the business could be enough to still want you to hold the stock, you want both engines driving your returns. You want that discovery process and the fundamentals working, because that's when you get your maximum output in that share price, right? So we're looking for all those things, but one by itself doesn't necessarily tell us, okay, it's time to sell. If the company's still growing very rapidly, if it still looks like it's got good runway, and there's nothing else that's better, then we're going to still hold that stock.
So after investing in multi-baggers that you look for so long, one of the biggest mistakes that Buffett always talks about is mistakes of omission.
Mm.
So this is, things like selling stocks that maybe are still early on in their growth trajectory, or just, missing something, letting something fall through the cracks.
Mm-hmm.
So it sounds like your system is designed very specifically to not allow that to happen. But can you discuss if that has happened, or if there's, something that was just looking back seems so obvious, it just smacks you upside the head and you're just like, oh my God, how did I miss this?
Yes, we don't have enough time to cover all the mistakes I've made of omissions. Right? Look, I mean, I think if you're going to do what we do, if you're going to be in the microcap space, you better get used to the fact that you're going to miss a whole bunch of them, right? And I remember I had an old mentor that told me one time, it's like fishing, right? At the end of the day, you're trying to catch one big fish and be happy about it. You're not sitting there in a river or lake trying to catch all the fish, right? You should be happy when you've got one big winner, and that's it. You're going to miss so many. Goodness, I've missed so many. I've sold too many big winners early. You just got to get used to that. And if you're fishing in the right spot, you're going to want to hope to have said, okay, I saw that, but I missed it, rather than I never saw it, right? So I've had in my hands, I keep, almost crying about this, but in my hands, I've had probably half a dozen 100 baggers. Like, I've owned these things and sold far too early, right? That's just the nature of how we, sort of the criteria we have will identify them, or identify most of them, but it's just impossible to own them all. And it's impossible to time it right. And it's impossible to hold them to the maximum ownership, right? You just got to get used to the fact that's going to happen. Like, you're not going to, again, I'll use a hockey analogy. You're not going to hit every shot and score every shot. You just got to keep taking shots and hope that the odd one gets in.
Yeah. It seems like, making those mistakes of omission is part of the investing process. And you basically just have to accept that it's a price that you pay for success.
Absolutely. Like, we will, because we know every stock in Canada, right? We've looked at every stock. We have to know that we're going to miss some. That's what's going to happen. I like I said, I almost cry every time I think of a few of these that I had in my head. Yeah.
So other than XPEL, what are some of the biggest winners in terms of returns that you've ever invested in? Obviously, aside from these half dozen 100 baggers that you let go early, although maybe some of those probably were ones that were big winners for you.
Well, okay, so Bowflex was a big win. I mean, I can't say no to 10, 12x return. That was a good size win, and it was early, so that was really helpful. But there's a lot of microcaps that people have probably never heard of that are like, they were 10xers for me, and I was able to compound a lot of these things. So, a company called Senko Tech was a 10x. Nobody's ever heard of that still. Hamilton Thorne, which is now quite institutionally owned and is a great example of discovery process. That was a 15x for us. So that was a sizable one. So Bowflex. Medifast was a US listed company that is one of those 100 baggers that slipped through my fingers. We were buying it in the 20 cent level. I think after splits, that's become a $100 plus stock. Oh my gosh, there's so many of these 10, 20 baggers that we have that they're still kind of unknown. We recently had one called Inventronics that's turned into a 10-bagger for us. Um, yeah, I can give you a massive list. There's a lot of these things, but they're still relatively unknown. These microcaps that turn into slightly bigger microcaps, but are 10, 20 times our original money.
So you mentioned in another interview about XBEL being an American company that listed in Canada
Mhm.
because it wanted to take advantage of going public over raising capital from venture capital. Um, how do you see the VC market shaping in the last few years in relation to smaller businesses looking to raise capital, both in the US and in Canada? Like, are there still businesses like XBEL that are US based listing in Canada, or has that kind of ship sailed?
Yeah, no, so I actually have done work with the TSX Venture Exchange and have gone to the US and presented on behalf of the exchange to try to encourage more and more companies to do this. Um, yes, there's more and more companies that are looking at Canada and the Canadian exchanges for their capital requirements. Um, the venture capital market, the US and even in Canada, they're really trying to find that one outlier, that unicorn, that company that is going to be that power driver of their portfolio, the next Uber and LinkedIn and whatnot. And so if a company looks like they're just going to be an average business, they don't have the same access to capital that a company would if they took that average business and tried to list up in Canada. So I think more and more people are starting to understand that. We're starting to see more U.S. companies that come and list up here. Like I mentioned, another big winner for us was Hamilton Thorne. Well, Hamilton Thorne is a Boston-based business that listed up here in Canada. We're seeing a number of others like that are seeing the opportunity to access capital up here at an earlier stage in some cases, and are the venture capital market or the microcap market in Canada is a viable opportunity for some of these businesses to get capital that they need to grow. And it's structured so that they can sort of do it in a more cost-effective way than a lot of other opportunities. So yeah, I think we're seeing it. And I think we'll continue to see not just US listed companies, but international companies that are coming up here and listing and going through all the trials and tribulations that Canadian companies do when they're startups and at this stage as a public company.
Can you name any interesting companies that you've recently invested in or that are maybe on the SEDAR that are starting to interest you? Anything new?
Yeah, there's always something. We're not fad chasers, right? So we miss a lot of the big bubbles and stuff like that. But surprisingly, like cannabis is a great example. Right now, we completely miss the cannabis craze because we're driven by fundamentals, right? And there was no fundamentals to get us excited. But now it's come full circle, and surprisingly, we're starting to see some cannabis names that are starting to turn profitable and are kind of, we think significantly mispriced, misunderstood, and almost hated because they're in that industry. So there's a company called Cannabis Capital. I mean, they've got some of the strangest names of that industry, but Cannabis Capital is one we really like. There's one called Grown Row. That's actually a U.S. listed or U.S. based company that's come up here in Canada, and like we just talked about, listed up here. These are two companies we're looking at right now because they fill our sort of fundamental criteria. They've got that inflection point. But here's the thing: nobody knows these guys. I actually had lunch with a cannabis analyst 3 weeks ago, and he'd never heard of these two companies, right? So the discovery process kind of really kicked in when I heard that, right? So you've got these two companies that are profitable and growing nicely, very unloved sector that they're in, and very unknown, right? So kind of hit a lot of the things we're looking for. So there's that. There's a company that I recently joined the board of that sort of fit all the criteria. I won't mention the name as there's a bit of a conflict there, but there's a number of different companies that we're finding, Hammond Power, Hammond Manufacturing. These are two names that have done exceedingly well. Those are companies that we've been following now for a while. It's almost like you ask me next week, I'll have a few more names. There's always something that gets us interested enough to start looking. We do have a new name that we're looking at right now. Again, they meet the criteria we look for. They start to trigger that sort of, we see that inflection point we get excited about, and off we go. So there's lots out there. There's lots out there. Yeah.
Paul, thank you so much for joining me today. Before we close out the episode, where can the audience connect with you and learn more about you?
Well, perfect. Well, thank you, Kyle. First off, I want to really appreciate the time that you've given me. If anybody's interested in talking to me, they can find me on Twitter at Paul Andreola. They can check out our website at smallcapdiscoveries.com. Yeah, I mean, it's easy. Track me down. Google search me. You'll find all sorts of different ways to connect with me. But our website, or even if you want to reach out to me via email, it's at Paul at brisgio.com. So hopefully that gives everybody enough opportunity to track me down.
It's a well-established fact that more activity is the most damaging thing you can do to your portfolio. I had to wait 16 years to buy Google. Now, I could have been wrong every one of those 16 years, but I have to stay true to my investment philosophy. If I'm going to abandon that rule because everybody else likes Google, or I saw a buy recommendation from Morgan Stanley on the company, then really, I don't have a philosophy.